What's up? Today we'll be taking a look at clean energy ETFs ICLN, TAN, PBW, and QCLN. We will discuss the bull and bear cases for investing in clean energy. For each ETF, we will look at portfolio composition, cost, performance, analyst ratings, and at the end, I'll give my own opinion for whatever that's worth. If at any point you decide you like this video, feel free to hit the like button because that's what it's for. Without further ado, let's get started. Global energy demand continues to rise, and now more than ever, we continue to see the detrimental effects of fossil fuels. There is an increasing demand for sustainable energy solutions. As costs continue to fall and clean energy technologies continue to improve, it starts to make more and more sense for individuals and institutions to switch to green solutions. The clean energy sector is expected to receive $5.1 trillion of investment by 2030. Ultimately, the planet really depends on the success of green energy, so in that sense, a transition is a must. Additionally, institutional money often has to comply with ESG criteria, this being environmental social governance. These are a set of standards for a company's operations that socially conscious investors use to screen potential investments. Simply put, many refuse or are unable to invest in tobacco, oil, and gas out of ethics. Instead, that money flows into sustainable investments. It can be hard to pick the winners of these industries, kind of like finding a needle in a haystack. Buying clean energy ETFs provides broad exposure to the industry as a whole, essentially buying the haystack instead of looking for the needle in the haystack. To play devil's advocate, I will present the bear case at the end of the video, but for now I don't want to spoil the fun. So let's introduce the ETFs. ICLN is the iShares Global Clean Energy ETF by BlackRock. It has been around since 2008 and has $6 billion in assets under management. TAN is the Invesco Solar ETF. It has been around since 2008 and has $3.6 billion in assets under management. PBW is the Invesco Welderhill Clean Energy ETF. It has been around since 2005 and has $2.3 billion in assets under management. QCLN is the First Trust NASDAQ Clean Edge Green Energy Index ETF. It has been around since 2007 and has $2.8 billion in assets under management. So while ICLN, PBW, and QCLN are relatively diversified across clean energy, TAN focuses completely on solar energy. Those that are bullish on wind energy should check out FAN. Let's move on to portfolio composition. It is clear that ICLN and TAN are more globally diverse than PBW and QCLN. PBW and QCLN roughly have 80% of their holdings in the US and 10% in China, give or take a few percent. ICLN and TAN have roughly the same exposure at around 40 to 45%, but TAN has a higher exposure to China at 21%, and ICLN has a higher exposure to European countries at 43%. So while ICLN may be the most globally diverse, with TAN a close second, it just depends on if investors value this kind of international diversity. Some investors would rather invest domestically. International markets have historically trailed US markets, but that could change at any time. Let's take a look at market capitalization. ICLN is actually the only ETF on this list that has a large cap majority. TAN and QCLN have a mid-cap majority, and PBW has a small-cap majority. There's definitely some volatility that comes with having a high percentage of small-cap companies. While small caps are more likely to get hit harder in a market crisis, they have some attractive upside in a bull market that can make it worth the risk for many investors. I will only take a quick glance at sector exposure. For those that love tech, TAN is the most tech-focused at 52%. QCLN is the second, with tech at 35%. But QCLN also has a large exposure to consumer discretionary at 35%. ICLN leads the way with utilities at 50%, and PBW leads the way with industrials at 40%. Moving on to industry exposure, I'm not sure how much these charts really help us differentiate these ETFs, but it's some more digging and I can summarize the differences. ICLN provides broad global exposure to the clean energy market, with companies involved in wind, solar, hydroelectric, and alternative energy sources, as well as companies that provide clean energy tech. PBW also takes a broad focus, but comparatively has more of an industrial and manufacturing focus than ICLN, with less exposure to pure energy plays like utilities and power producers. It also leans a bit more solar heavy. As mentioned before, QCLN is more of a tech play than ICLN and PBW, with investments in manufacturers, developers, distributors, and installers of materials, energy tech, energy storage and conversion, or renewable energy production. When we go through the holdings later, it'll be clear that QCLN has a focus on electric vehicles for those that love EVs. TAN is a pretty easy one to summarize as it's focused on all aspects of the solar energy industry. Also, if some are confused as to why oil and gas and consumable fuels are showing up as a category, that has got to be exposure to hydrogen fuel cell companies. Either that or somebody messed up. Moving on to top holdings, ICLN has the most holdings at 103 total. The rest of the ETFs are hovering in the 50 to 60 range. TAN has the highest percentage of weight in the top 10 names, PBW has the lowest percentage of weight in the top 10 names, and takes an equal weighting approach. Equal weighted ETFs inherently have a sell high, buy low strategy, as they have to sell off the winners and buy more of the losers to maintain equal weight. However, this can lead to more turnover and higher taxable events. Equal weight provides more diversification, but it can limit your exposure to some of the strongest performing names. Many of the companies in these ETFs are not household names. We see Enphase Energy, Plug Power, and SolarEdge in the top 10 of iClean. TAN can be great for those bullish on Enphase and SolarEdge, as it has 20% of weight in those names, but there certainly is a concentration risk to this. Like I mentioned, QCLN has the greatest exposure to EVs, with Tesla and NIO making up the top two holdings at a combined 16%. For those unaware, NIO is basically the Chinese Tesla. Tesla is such a polarizing name. If you love Tesla, maybe QCLN is for you. If you hate Tesla, steer clear of this one. But we should also consider anyone that owns ARK ETFs already has a large exposure to Tesla. In their case, they might avoid QCLN for the sake of not being too heavy in one name. Same thing goes for people that already own the stock. Let's take a look at cost. And first with that, expense ratio, the annual percentage that we have to pay for management. iClean is 0.46%. TAN is 0.69%. Elon Musk will be proud. PBW is 0.7% and QCLN is 0.6%. So on a $1,000 investment, iClean will cost you $4.6. TAN will cost you $6.9, PBW will cost you $7, and QCLN will cost you $6. So iClean is the clear winner on expense ratio. I don't want to sound like a cheapskate, but I'm not going to sugarcoat it. These fees are high, particularly when you get up in the 0.6 to 0.7% range, which may not sound like much, but there are S&P 500 ETF issuers that charge 0.03 and 0.04% annually, which is basically nothing. Granted, obviously they track a different index, but sometimes we've got to be careful to not step over dollars to pick up pennies. Anyone that buys specialized ETFs like these are banking on outperformance that will well offset the small differences in costs. But small differences in costs can add up to large differences over time. You don't really think about it in a bull market, but it can be a real bummer in a bear market when your portfolio goes down or sideways and you're getting eaten into by fees. This calculator shows the concept. If you invest $6,000 a year into two ETFs, one with a 0.7% expense ratio and one with a 0.03% expense ratio, assuming equal returns of 6%, the 0.7% expense ratio will cost you $155,000 more over 40 years. But again, this assumes all other things are equal, which is a big assumption. Continuing on cost, let's take a look at the tracking differences of each. Tracking difference shows how a product's performance compares with that of its benchmark over a stated period of time. An index is an ideal representation of the market, while an index fund is an actual implementation of it. So tracking difference is a good report card for how well a manager is doing. It can depend on factors such as expense ratio, rebalancing costs, sampling, cash drag, security lending, and rebalancing timing. Given that fees are included, tracking difference is typically negative. The tracking difference for each is as follows: minus 0.44% for iClean, minus 1.95% for TAN, a positive 1.41% for PBW, meaning it actually outperformed its index, and minus 2.67% for QCLN. A minus 2% tracking difference is definitely not impressive. Contrast this with something like VOO, which tracks the S&P 500 and has a tracking difference of minus 0.05%. We really don't want to be leaving money on the table with a bad tracking difference, but we have to give a big win to PBW. It usually beats its index, probably by securities lending. Let's cover spread costs, but we won't want to spend too much time on it. Spread is the measure of liquidity and the cost of trading shares. Essentially, the difference between the lowest ask price and the highest bid price. The lower the spread is, the lower the cost is to trade. Typically, the larger a fund is and the larger the trading volume, the lower the spread. The average spread for each is as follows: 0.04% for iClean, 0.11% for TAN, 0.15% for PBW, and 0.07% for QCLN. We'll give the win to iClean, but really nothing to worry about here, as these are all tight spreads. No surprises, these are all large and liquid ETFs. This kind of liquidity is important for traders frequently moving large amounts of shares, but it's not as important for a buy and hold investor. Let's move on to performance, which can be either really good or really terrible depending on when bought and sold. The story with these ETFs is they got pumped to the moon back in 2008 on the hype of revolutionary transition to sustainable energy. But the prices were way too high and the technology was not ready. They crashed with the rest of the market and basically did nothing for over 10 years. Then in 2020, they got pumped back to the moon again before experiencing a sharp correction in 2021. Some would say that 2008 was their dot-com bubble for clean energy, and while they weren't ready then, they are ready for prime time now. Others would say it's basically the same hype all over again. Keep in mind, when we look at the returns, pretty much all the returns for these ETFs occurred in 2020. TAN was the strongest 2020 performer. It has a 147% one-year return, which is insanity. PBW and QCLN both have 132% one-year returns, and iClean is lagging behind at an 89% one-year return, which is still insane. The 10-year average returns for these ETFs are much more sobering. iClean and TAN both average 5% and 6%, and again, this includes the 2020 bull run that we just talked about. PBW was a little better at 10%, and QCLN was the only one to beat the S&P 500 with an average return of 16%. So we can give the most recent performance win to TAN, but the long-term performance win to QCLN. But honestly, none of these graphs look great compared to the S&P 500 and the NASDAQ 100 over the same time period since 2008. But past performance is no guarantee of future results. It only matters what happens moving forward. Let's take a look at dividend yield. I wouldn't expect high dividends from growing companies in a growing field. They are more likely to reinvest back into the growth of the company as opposed to paying shareholders. We have 0.42% for iClean, 0.12% for TAN, 0.58% for PBW, and 0.25% for QCLN. So we can give the dividend win to PBW with iClean a close second. But again, people don't buy these for the dividends. They buy them for the growth. Another thing investors should consider is risk-adjusted returns. How much risk do you have to take to get how much return? Beginner investors tend to be unaware of how much risk they're taking, and they tend to focus only on returns. And then when a correction comes, they find out, and by then it's too late. They got caught skinny dipping when the low tide came in. For instance, some people will YOLO their entire life savings into hamster coin, which is insanely risky. Anyway, this graph plots 3-year standard deviation with 3-year average annual return. The further right, the higher risk. The further up, the higher return. So you can see TAN and PBW are plotted as more risky. For a similar return, QCLN is plotted as less risky, and iClean is plotted with less risk and less returns than the other three. But I also plotted VOO for reference. Comparatively, these clean energy ETFs are all high risk, high reward, but again, this only considers the last 3 years, including that 2020 bull run. And again, all that matters is what happens moving forward. Also, I'm not sure what this ETF is down here, but I am staying far away from it. Let's take a look at some other relevant factors. You can see that all of these ETFs are underweight when it comes to companies with good balance sheets, PBW being the most underweight. As we touched on before, TAN, PBW, and QCLN are shown as being more risky and more volatile than iClean. Also, iClean is shown to have more inexpensive stocks compared to the other three. Not necessarily saying they are inexpensive in general, just compared to the other three. Lastly, let's look at analyst ratings. Morningstar straight up roasted all these ETFs. QCLN was the only one to get more than 1 star with a whopping 2 stars out of 5. FactSet gave all these ETFs a B rating except TAN, which flunked out of school with a D. TAN's parents are going to be so disappointed, and TAN is probably going to get grounded. So what are my thoughts? I really hate being a bear, but I do not own any clean energy ETFs. It's not because I don't like clean energy. It's important and I root for its success. I don't fault anyone for owning these. Investing in these companies is a way to help make sure that the world becomes more sustainable. And I can't say that I wouldn't buy in the future, but remember, there are 2 ways to be wrong with investing. You can be wrong and you can be right, but at the wrong time. The people in 2008 knew clean energy would be the future, but it was too early to be a good investment. Also remember, every dollar has an opportunity cost, that being what that dollar could be doing if it weren't doing what it's currently doing. I'm not saying these ETFs can't do well in the future, but I personally think there are safer and higher percentage ways to get good returns moving forward. Continuing with the bear case, margins can be thin in clean energy. Competition is high, prices are high, and many times clean energy can be subject to the whims of government. Many of these companies can live and die by government subsidies. Many of them have expensive stock prices and less than stellar balance sheets. While green energy is the future, it's possible that years' worth of growth is already priced into the market. That would mean less than stellar returns moving forward. Also, just because something is revolutionary does not necessarily mean that it's profitable. For instance, the airline industry has been revolutionary. However, it is, in aggregate, mostly lost money during its existence. The future is not always a good investment. It's concerning how this sector has a history of boom and bust cycles. Skilled traders can make money off this, but I prefer to keep my investing long term because of the grim statistics of retail trading. Also, again, the costs of these ETFs are relatively high. I would like to see more ETF competition in the clean energy space to drive down some of the managing costs. If you disagree and think these ETFs are going to the moon, please refrain from hitting the dislike button, because that will cause me to cry myself to sleep as I derive my self-worth purely from likes from strangers on the internet. Just kidding, but feel free to comment your thoughts below and explain why you think these ETFs are going to the moon. But if I were to buy any of these ETFs, it would probably be a 50-50 split between iClean and QCLN. iClean because of its broad diversification in the clean energy sector, lower level of risk, and the cost being lower than the rest. QClean because of the long-term performance and the higher exposure to clean energy tech. I am always a fan of when companies invest in innovation to drive growth in their industry, but I would like to see QClean have a tighter tracking difference. But if you found any of this helpful, please consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently, down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 with M1 Finance, a free stock with Robinhood, potentially valued up to $225, and up to $250 with BlockFi, where you can earn interest on your cryptocurrencies. As always, this is not to be considered financial advice. It's for entertainment purposes only. Thanks, and I'll see you in the next video.